right? So let's get going straight away with today's content. It's on foreign exchange, right? So foreign exchange is actually very simple. It might sound very complicated, but now to me, foreign exchange is, well, actually nothing new. Not only to me, but even for you all. Perhaps some of you would have already learned about foreign exchange. You would have covered quite a lot, right? So the easiest way to understand foreign exchange is, now, if you know how to buy a loaf of bread, right? Bread. It is the same as buying and selling foreign exchange. Hardly any difference, almost the same. So if you know to buy bread, then you know foreign exchange. It's as good as that. Right? Foreign exchange markets is the market in which the currency of one country is exchanged for the currency of another country. And so you exchange one currency against another. Very simply, it's like exchanging money against loaf of bread or apples, oranges, anything. Why foreign exchange? For capital and trade transactions, for your capital account and your current account, you need foreign exchange, because other countries have their own currency. The entire world does not use the same currency for various reasons, right? One of the main reasons is they lose monetary policy independence if you use a common currency. Like, for example, you take the Eurozone, they are using the euro, whereas all the countries in the Eurozone is using euro. So if there is a particular country wants to do some money printing, they might not be able to do so. Okay, so that's one of the main reasons. Monetary policy independence is lost. There are other reasons, like political reasons. So for that reason, all countries have their own, most countries have their own currency, except the Eurozone, which is a supranational entity. When a country buys goods and services or invests in another country, the country has to obtain some of the other country's currency to make that transaction, right? So very basic stuff. The market structure is around the clock, almost 24/7. It's not 20, sorry, it's almost a 24-hour market. It doesn't operate during weekends, closed during weekends. There is no central location, so it's not that the foreign exchange market is controlled in the US or UK. There is nothing as such. Regardless of which location is closed, the market still functions. Right, which center is closed does not matter. Over-the-counter market. That means you can, it's like buying a loaf of bread, right? You can do it over the counter. Not an exchange-traded transaction. It's unlike stock exchange. Highly liquid. Very liquid. The daily volume is about $5.3 trillion a day. It's one of the largest markets in the world now. So you have $5.3 trillion trading every day in the foreign exchange market, right? 5.3 million, 5.3 billion, 5.3 trillion. Sri Lanka's daily volume is about 100 million. On a good day, it's about 100 million. Meaning our contribution to the foreign exchange market roughly for that much. Approximately. It's like a rounding of error. That's out of 5.3 trillion, we are contributing only about $100 million a day on a good day. Usually it's much less than that. These are the main centers: UK, Hong Kong, Japan, Singapore, US. Interestingly, most of the volumes happen during UK time. That is because UK overlaps with Asia as well as the US, right? So most of the transactions occur during that time. And the main currency is the G7s basically. Then the market structure. Participants are exporters and importers, right? People who export as well as import. Banks, brokers, investors and speculators. That's the interesting thing because investors and speculators, now, genuine transaction bank volume in the foreign exchange market is only about 5%. 95% is speculative. Only 5% are genuine transactions. Then we have central banks. They buy or sell foreign exchange to curb excess volatility in the markets. The central banks also intervene. Sometimes to boost their reserves, they buy foreign exchange from markets. Now, you all would have seen in print media that the central bank has, and they have mentioned that they have been buying foreign exchange from the market for our debt repayments and to boost reserves and all that. So this is how the domestic foreign exchange market functions. Exporters will receive foreign exchange, and like the tea exporting companies will send tea overseas, they get foreign exchange, and that foreign exchange is then it circulates in the economy. Within banks, goes to maybe importers, and banks trade amongst themselves, and central bank also in between can buy, or they can even sell some of their reserves. Then finally, it is taken out of the country by importers. That is the cycle. Then the important terminology: trade date means the date on which a transaction was done. Right? Remember, transaction was agreed. The transaction is agreed on the trade date. Value date is when the transaction is settled. Right? So actual cash flow exchanges on the value date. Value dates, there are several types: cash terms, spot and forward. Cash terms, spot and forward. Right? Cash means same day settlement. Term means tomorrow. So in other words, T plus 1. Spot is 2 working days. That is T plus 2. Forward is anything beyond T plus 2. These are the 4 different terms. And there are always 2 parties to a transaction: the price maker or the market maker, the quoter, and the price taker or the ask. Okay. And the easiest way to understand is if you go to a supermarket, to buy mangoes. The supermarket, say, one mango is 100 rupees. So if you go to the supermarket and you want to buy, the supermarket is the one that is quoting you the price. It is not that you go to the supermarket and tell them that you will buy mangoes at 100 rupees. The supermarket will tell you that you can buy mangoes at 100. Yeah? So you are using the price quoted by the supermarket. Okay. The customer in this case is the okay. The supermarket is the holder. And ask. I hope that's understood. An exchange rate is the value of 1 unit of a currency in terms of another currency. How much is 1 unit in terms of another currency? For example, now in this case, 1 mango is 100 rupees. Right, 1 mango, 100 rupees. So you can write it as the mango to rupee exchange rate is 200. So it's 200. Mango to rupee exchange rate is 200. Right? This gives the price of 1 mango in terms of rupees. Now, instead of using dollars and all that, I'm using mango. So that it's easier to understand. All you have to do is replace mango with dollar, then you will understand foreign exchange. Right? Now, the mango is written first. It is called the base currency. Then the rupee written second, it is called the counter currency. Base currency is the currency which is being priced. Right? It's, in other words, the currency that is written first. An exchange rate between two currencies is the price of the base currency expressed in units of the quoted currency. Right. So this exchange rate gives you the price of a mango in terms of rupees, the price of the base currency in terms of the counter currency. Direct quote. So let's go through the definition of direct quote. The number of domestic currency units per one foreign currency unit. If you have noticed, if you watch news, you may have noticed that they give the price of $1 in terms of rupees. $1 is 200 rupees, or £1 is 300 rupees, or whatever. Right? $1 in rupee terms. Right. Now for a Sri Lankan, dollar is the foreign currency. Rupee is the local currency. So 1 unit of foreign currency in terms of local currency is called a direct quote. It's called direct quote. Right. So it gives the number of currency units per dollar. Now that is a technical definition. 1 unit of foreign currency in terms of local currency. But you can have an alternative definition. That is, this is how it's done practically. If the dollar is written first, then it's a direct quote. You also have indirect quotes. That is the opposite. Technical definition is 1 unit of local currency in terms of foreign currency. One unit of local currency in terms of foreign currency is called indirect quote. One unit of local currency in terms of foreign currency is the indirect quote. Okay. But practically, if the dollar is written second, the dollar is the other side, then indirect. There are four major currencies which usually quote indirect: sterling, euro, Australian dollar, and New Zealand dollar. It's clear. Purchasing power parity theory. Purchasing power parity says that an identical good, identical stuff in two different countries, the price of identical goods in two different countries should reflect the exchange rate between the two countries, right? So identical good price, the price of identical goods in two different countries will reflect the exchange rate between the two countries, right? Which means now, if you take for example McDonald's, let's say Big Mac. In the US, it might be worth $5 in the US, right? Sri Lanka, a Big Mac would be worth 1,000 according to purchasing power parity, right? So assuming these are identical, Big Mac in the US is the same size, same weight, same quality, same taste, everything is identical. Let's assume if that is the case, what it says is the exchange rate between, the price between the two countries, the price of the two countries reflect the exchange rate between the two currencies, right? So according to this, $1 should be equivalent to 1,000 divided by 5, 200 rupees. That's called purchasing power parity. So let's try this example. Very simple example. A chocolate bar that sells for 150 Canadian dollars in a Canadian city should cost $1 in a US city. A chocolate bar that sells for 150 Canadian dollars in a Canadian city should cost $1 in the US. When the exchange rate between Canada and US is 150. Right. So in Canadian dollars, it is 150. US dollars, it is 1. So the US dollar to Canadian dollar exchange rate would be 150 divided by 150. Now remember, it is the mango rupee example. This means $1 is equal to 150 Canadian dollars. Right. Now let me ask you a question. Out of these two currencies, the US dollar and Canadian dollar, out of these two currencies, US dollar and the Canadian dollar, which currency is stronger in the dollar is stronger or Canadian is stronger? Yeah, okay. Why do you say the US is stronger? Why do you think the US is stronger? How would you know when a currency is stronger? Look at the exchange rate, right? This exchange rate. I'll explain using another example. Let's say one mango is 200 rupees, right? Now, out of these two, which one is stronger? Mango is stronger, rupee is stronger. Yeah. How do I identify out of these two? The mango and rupee, is the mango stronger or the rupee stronger? Answer is mango is stronger. Why? Because look at this exchange rate. If the exchange rate is more than one, if exchange rate more than one, it means this currency is strong. If the exchange rate is more than one, that means this currency is strong. So likewise, if exchange rate less than one, it means the base currency is weak. Understood? So likewise, the US dollar Canadian dollar example, exchange rate is 1.5, which is more than one. It's more than one, the base currency should be stronger. Therefore, the US dollar is stronger than the Canadian dollar. Okay. Had this been something like 0.9, if it was 0.9, that means the exchange rate is less than one, so the base currency is weaker. Base dollar is weaker than Canadian. Interest rate parity, we will come back later. Right, so let's see this using exchange rates and calculations. Okay, so let's try this. Given the exchange rate of 132 rupees 132. If you have $10 million, how much can you get in rupees? USD. And here, given us 132. For $1, 132 rupees. If you have $10 million, it's 132 into 10 million, which is 1,320. And if you have 100 million rupees, how much can you get in dollars? So 130, the same thing. Writing as 132 rupees is 1 US dollar, which means 1 rupee is 1 divided by 132. US dollars. You have 100 million rupees. $1.76 million US dollars. And if you look at this exchange rate, it's more than 1. Therefore, the base currency is stronger, so dollar is stronger than rupee. The next one, given the exchange rate of euro sterling 0.8585. If you have 10 million euros, how much can you get in sterling? Then if you have 10 million sterling, how much can you get in euros? Right? So somewhat similar. Now this exchange rate is less than 1. Which it means the base currency is weaker. The euro is weaker than sterling. Right? Euros is 85 sterling. So 1 euro is 0.85 sterling. If you have 10 million euro, it's 10 million 0.8585 sterling. 8.585 million sterling. Okay. So next question is, if you have 10 million sterling, how much can you get in euro? If I put this other way around, 0.85 sterling is 1 sterling. One divided by 5.8585 euro. And if you have 10 million sterling, $11.65 million. I hope that was clear. Currency movements. Now, say, if the price of a mango, if it goes from if it goes from 100 to 200 in rupees, right? If the price goes from 100 to 200, which one has increased in value? Has the mango increased in value, or has the rupee increased in value? Jani or Infanta, what do you all think? Which one increases in value if price of mango goes from 100 to 200? Mango value has increased, right? So the mango price has increased. Then if you go to the slide again, if the dollar against rupee goes from 132.20 to 132, that is something like this, the price of a mango going from 100 rupees to 50 rupees, that means the price of the mango has reduced, right? If it goes up, the price of the base currency of the mango is increasing. Goes down means the price of the base currency of the mango is dropping. For example, if the dollar rupee goes from 132.20, if it drops to 132, that means the price of the dollar or the dollar is weakening. The price of the dollar has gone down, therefore the dollar is weakening. The dollar is weakening, obviously the rupee is strengthening. By what percentage? In this case, it has dropped by 50 rupees, started at 100, so it's down 50%. And so likewise, from 132.20, it goes to 132. That means the base currency of the dollar has weakened. Percentage, it's down 20%. 20% down, start at 132.20. Percentage drop. 0.15%. Then the next question is sterling dollar goes from 150 down to 152. Then what happens? If the sterling goes from 152.50 to 152, that means the price, the value has dropped. Which one is dropping in value? The sterling is dropping or the dollar is dropping? Yeah, the sterling is dropping, right? Because of the price has dropped. That means the base currency has dropped. If the base currency has dropped, that means the dollar has strengthened. And by what percentage? Down by 0.005. And it's 2 minus 1. It's negative. Deadline offer. Right. So let's say you have gone to a supermarket and you want to buy mangoes. Supermarket will tell you that they will sell you mangoes at 100 rupees, right? So one mango will be sold to you at a price of 100. That is if you want to buy. So the supermarket now is the market name. The code. Customer is the market taker or the asker. If this customer wants to buy a mango from the supermarket, they will have to buy at price of 100. Right? That is the price at which the supermarket is willing to sell mangoes to the customer. They are willing to sell mangoes to the customer at a price of 100. Right now, in this case, one mango is 100 rupees. The supermarket is willing to sell the base currency at a price of 100. They're willing to sell, or they're willing to offer base currency at price of 100. Now, what if you want to sell mangoes to the supermarket? If you have a mango plantation and you are looking to sell mangoes to the supermarket, at what price do you think the supermarket will purchase mangoes from you? If you want to sell mangoes to the supermarket, at what price can you sell mangoes to them? Will it be higher than 100 or less than 100? If you want to sell mangoes to the supermarket will buy mangoes from you at a price which is more than 100 or less than 100. Yeah. So they will tell you that they will buy, or they will bid for mangoes at a price of 90. Right? So the customer can sell mangoes to the supermarket at 90. He will buy mangoes from the supermarket at 100. Right? In other words, the supermarket will buy mangoes at 90 and they will sell mangoes at 100. So the buying price of the bid is 90, selling price of the offer is 100. This is called bid and offer. So bid is the price at which the market maker will buy the base currency. Offer is the price at which the market maker will sell the base currency. Bid and offer. Input terms. Understood? Then the spread. Right? Spread means the difference between bid and offer. It's the offer minus the bid. Okay. In this case, it's 100 minus 90. So the spread in this case is 10. Now let me ask you a question. What if this was reversed? What if bid was 100, offer was 10? Sorry, offer was 90. What if the bid was 100, and what if this was 100 and the offer was 90? Then what happens? Any idea what happens? If this was the case, the customer can benefit. Why? Because he can buy mangoes from the supermarket at 90 rupees, and the same mango he can sell to the supermarket at 100. Because the supermarket in this case is buying mangoes at 100, they're selling mangoes at 90. So the customer, all he has to do is buy mangoes at 90 and sell it to the same supermarket at 100. He will make a 10% profit straight away. Therefore, that is not allowed. Always the bid is lower than the offer. Bid should be lower than offer. Otherwise, there will be what is called an arbitrage opportunity. So the next one. On this example, says the euro dollar is 1.3275. At 1.3275. Now, there are some currencies which go up to 4 decimals, some currencies go up to 2 decimals. And if a currency goes up to 4 decimals or 2 decimals, there is a cut, you can cut off the last 2 decimals. And the last 2 decimals are called the pips. And the first 2 decimals, the first set of decimals are called big figure. The big figure and pips. Like the last 2 digits are called pips. What comes before the pips are called big figure. So what is quoted in the market are the pips, right? If anyone is quoting a euro price, you will only hear 75.85, 75.80. They will not quote big figure. Reason? It's assumed that you're in the market and you know what the big figure is. Right? If you're in the market, you definitely know what the big figure is. So what is quoted are only the pips. Now, this is how a typical foreign exchange transaction takes place. Right? Now, if you just contrast this with going and depositing 100 rupees in a bank, you need to fill a slip, give it to the cashier will go and get it authorized by the senior officer. It will come back to you, or you get cash, you sign it and give it back, right? But if you're doing a $1 million transaction in foreign exchange, it will not happen like that. Okay, so this is a simple, like a WhatsApp chat, a simple chat screen. Now, this is happening between 2 banks. The first bank will ask the price for Aussie 5 million. So what does this Aussie 5 million means? He's asking a quote for Australian dollar, US dollar, 5 million. Right? And then this person called Sven says 15.17. And those are the pips. He's quoting the pips. Sven is bidding at 15, he's offering at 17. What is he bidding and offering? This is the price that he's quoting to buy and sell Aussie dollars against US, right? So Aussie is the base currency. Then the other trader called Nalika says, I buy. What is she buying? She is buying the base currency. And Nalika is buying the base currency. Now in this example, the price is being quoted by Sven. So Sven is the market taker. Sorry, market maker. Nalika is the market taker. Right? Sven is quoting a price of 15.17. That means Sven will buy Aussie dollars at 15. He will sell Aussie dollars at 17. Right? It's a mango example. It's like the supermarket buying mangoes at 15, selling mangoes at 17. If Nalika or the market taker says, I buy, that means he's buying Aussie dollars. He's buying mangoes at a higher price at 17. Then Sven says, Nalika is buying Aussie dollars now. Nalika is buying Aussie dollars. Always 2 currencies. Nalika is selling US dollars, right? Which means Sven is buying US dollars and he's selling Aussie dollars, right? So when Sven buys US dollars, he needs to put it in his account. So he's giving his account settlement details. JP Morgan Chase New York, he gave the account and the value date. Then Narika also confirms the deal, reconfirms. He says at 99.17, Narika is buying Aussie dollars, buying the base currency at the offer, so it will be 17. Now he says the rate is 99.17. So in this example, 0.9917, right? You draw two decimals, the last two digits are the pips. This is the big figure. Big figure is 0.99. 0.99 is the big figure, 17 is pips. He buys 5 million Aussie dollars. Now he buys 5 million Aussie dollars at price of 99.17. Then the value date 31st January. So he's buying Aussie dollars means he has to give his Aussie dollar instructions given as Reserve Bank of Australia. That's it. This takes less than 10 seconds. Okay, so everything gets noted on top, and the transaction is closed. Then the back office settlement happens. Now this happens in the front office. After that, the rest of the process follows that. Middle office and then back office. Middle office and back office. We will come back to this later. Let's try these examples. Try these examples. First one is US dollar LKR is 132.50 and 132.74. Right. So the exchange rate is more than 1, therefore the base currency is strong, which means the US is strong. Base currency is the dollar, right? Currency first is the base currency. Bid is 132.50, offer 134.74. Yeah. Base. Second one, dollar yen, then 290.95. So what does this mean? It's 90, 102.90.95, right? Now these are the pips. The last two digits are the pips. What has been given are the pips. So the big figure will be 102.90. and 102.95. So without writing big figure, they give the pips only. So here it's 134.74. And that 134.74. Here it is difficult to give the pips only because the big figure is different, isn't it? It's 132, 134. Okay, it's possible. Right. So the basics exchange rate is more than 1. Therefore, the dollar is base currency is strong, which means dollar is strong. And this is the price of $1 in terms of yen. At what rate base currency is the dollar? At what rate can you buy dollars? Or at what rate can you buy the base currency? You can buy the base currency at the offer. Buy US dollar at 102.95 at the offer. What rate can you sell yen? Sell yen at 102.95. What rate can you sell dollars? At the bid, which is 102.90. Simple as that. Very easy, provided you get some basics right. So what are the basics? Basics of foreign exchange. Step 1. Identify the base currency. Very easy exercise. Identify the base currency. Step 2. Identify what to do to the base currency. You need to identify what needs to be done to the base currency. Then step 3. Sell base and bid and buy base and bid. Right now, this is all assuming you are the market taker. Always assume you are the market taker. And if you are the market taker, you need to remember these steps. So whatever you do, you need to remember these steps. And since you all are new to foreign exchange, always assume you are the market taker. If you are the market maker, you have to give the other way. Okay. So you are the market. Let's assume you are the market taker in this question. If you're the market taker and you need to, or the asker, right? If you are the asker, or taker, you can buy dollars at the offer. Like that. Dollar yen means base currency is dollar. You can buy the base currency at the offer. Buy dollars means you're buying the base currency, so you're buying the base currency. In this case, dollar is the base currency, right? First question, you need to buy dollars. You are buying the base currency. You can buy the base currency at the offer. Second question, selling yen. Selling yen means what I do to the base currency. If you are selling yen, that means base currency you are buying. Okay, so if you are the market taker, you can buy the base currency at the offer. And selling dollars, you are selling the base currency. The market taker, you are selling the base at the bid. And 90. Simple steps. This one, I hope that was clear. Next question. Sterling dollar. $153.25. 153. So if you are writing in terms of pips, I can say this 153.25. The first step, identify the base currency. Base is sterling. First currency is sterling, so that is the base. First question, at what rate can you buy dollars? Buy dollars means base you need to sell. You can sell the base at the bid, which is 153.25. What rate can you buy sterling? Buy sterling means you're buying the base at the bid. Buy sterling at 153. Next one, what rate can you sell dollars? So if you're selling dollars, you are buying the base currency, buying the base at the offer rate. Next question is on euro dollar. One 30, 10, 130, 15. 130, 10, 15. Identify the base. Base is the first currency, the euro. First question, at what rate can you buy dollars? Right? Buy dollars means the base you're selling. You sell the base at the bid. What rate can you buy euro? Euro is the base, so you're buying the base at the offer. What rate can you sell dollars? Sell dollars means buying the base at the offer. in a series of questions. Let's try them. And I want 50, 55. Euro dollar 131.75.80. This is quoted in pips. In other words, this is 101.50 and 101.55. Here you get 131.75, 131.80. First question, at what rate the quota sells dollars on dollar yen? Right. Q is the quota. A asker. At what rate the quota sells dollars on dollar yen? Dollar yen. Okay. Dollar yen. The quota will sell dollars at the. It's like the supermarket selling mangoes. Right? They will sell it at the higher price. Quota sells dollars at the higher price, which is 101.55. Second one, quota buys yen. Quota buys yen. And if the quota is buying yen, that means he is selling dollars. Buying yen is selling quota, or the market will sell mangoes at the. Third one, at what rate the asker buys dollars on dollar yen? Asker buys dollars on dollar yen at the offer. Okay. Because dollar is the base currency, you need to buy the base at the offer. And at 155. Number 4, what rate the asker sells dollars on euro dollar? ask sells dollars on euro dollar means if you are selling euro is the base, so selling dollars means you are buying euro. Selling dollars means the asker is buying euro at the offer 131.80. Fifth one, at what rate the asker sells euro on euro dollar? Asker will sell euro on euro dollar. Euro is the bid, so the asker will sell the base currency and bid. So euro is the base currency, asker will sell the base currency at the bid. 131.756. What rate the quote buys dollars on euro dollar? What rate the quote buys? Dollars on euro dollar. Quota buying dollars means the base currency. He's selling, he will sell the base currency at the offer. Seven. What rate the quota sells yen on dollar yen? The quota selling yen means he's buying dollars. Quota selling yen means he is buying dollars at the bid. And one. What rate the asker sells dollars on dollar yen? Asker will sell the base dollar is the base currency, so the asker will sell the base currency at the bid, which is 101.50. Right. So I hope that was clear. In trading position. trading position. Now let's assume you are selling mangoes, right? You are selling mangoes today on the 21st of March. Let's say the opening stocks at 0. Then we bought the 100 mangoes at 100. This is the mango and the rupee amount. Mango and rupee amounts. When we buy 100 mangoes, we will receive 100. So they are plus 100. Then in rupee terms, we will have to give away 10,000 rupees, right? If it costs us 10,000, so that's going out. Let's put it as negative, 10,000 negative. We receive 100 mangoes, we are giving away 10,000 rupees. Then let's say we bought another 50 mangoes at 120. We had 100 plus another 50 comes to 150 total mangoes. And we are spending 6,000. So they are total 16,000 minus. Right. Now let me put it this way. Let's use it to understand. Plus 50 minus 6,000. And so you go to it up, it comes to 150 mangoes total, spend 16,000. Now let's say you sold. Before that, let's say we have 150 mangoes, total spend 16,000 rupees. Right? Now we have bought mangoes, you have plus on mangoes. That means you are long mangoes. Overbought or long mangoes, and then 50. So let's say you didn't have any mangoes, you didn't have rupees, whatever you bought, you paid instantly. But let's say the rupees also were borrowed, borrowed money. You are using borrowed money to settle. Now you are overbought on mangoes, 150 mangoes. Then on rupees, you are oversold or short here 16,000. Short of 16,000 rupees. Then the next thing, let's say you sold 20 mangoes at 150. 20 mangoes you sold at 150. Here it is minus 20. Okay, 20 mangoes sold. If you sell mangoes, you will receive rupees. Rupees plus 3,000. You are receiving rupees, you are plus rupees. By the way, if you look at this, the average cost 3,000 divided by 150. And then 6.67. 106.67. Before you go to the sales side, your average cost is 106.67. Right? Which means if the price of a mango goes up, goes above 106.67, you will gain. Right? So if it goes to 120, if it goes to 150, you will gain. But if it comes to 100, or if it falls to if it falls to 100 or if it falls to 80, then you will lose. Your long mangoes, your risk is the price coming down. Which means if you're short mangoes, the risk is the price going up. Right. Okay, so now you have sold 20 mangoes at 150, so you are less 20, and you will receive 3,000 rupees for that. The net is plus 130, and it is your still short 13. There's time. Right. So let's say 21st March at the closing price of a mango. Let's assume is 200 rupees, right? End of the day, mango prices have gone up to 200 rupees. Then what happens? Now you have 130 mangoes plus. So let's say, let's assume it's not sold, but let's assume that at the end of the day, if you're closing out your position, you have 130 mangoes which can be sold at 200 bucks. Right? So if you sell at 30 at 200, you will receive to sell 130, 200, you will receive 26,000. Okay, so you are left with 0 mangoes, rupees, 13,000. That will be your profit. That's your profit. It reflects your profit. Now, in this case, you made money, you made profits because the closing price of mango has gone up. It is more than your average cost. Right. If you had no mangoes, throughout the day you had no mangoes, regardless of what happens in the market, a profit, you will not make a profit or a loss. Like you're not exposed to the price of a mango. But if you bought mangoes and it cost you average 106, suddenly if the price drops, you will lose. Right? If it comes to 8, you will lose. But if the price goes up, you will gain. So this exposure to mango is called a position. This is called the mango position. LKR position. And this term position means your exposure. Gives the exposure. Right. So I hope that was clear. Position is where traders have position against the base currency. Right, so that's what we discussed earlier. Short position means if he is a net seller. Right. Now, for example, let's say he had 150 mangoes at 16,000 at one point. Let's say all of a sudden he has sold, he said 200 mangoes. At this point, he sells 200 at price of 200. Okay. So he sold 200, he receives 40,000 rupees. So he receives plus net is 50 minus, and it is 24,000. The average now he has sold additional 50 mangoes. 50 mangoes additional sold. He has sold mangoes which he never had. That's called oversold or short. And the risk is, in this case, if the price goes above 480, he will lose. If it goes above 480, he will lose. Right? And conditional step. And how do you calculate profit or losses? Realized profit is the profit or loss of a totally squared position. Now, if you look at this, when the position is 0, it's called squared. And when the position is 0, the base currency amount that is left gives you the profit in, sorry, not the base currency, the counter currency amount that is left gives you the profit in counter currency. Unrealized profit is the profit or loss of an open position compared with its average rate against market rate. Right. The profit or loss is derived from the quoted of the counter currency. At 8 o'clock, let's try this example. 8 o'clock, sterling dollar is 158.50, and 5 minutes later it is 158.70. Now, sterling dollar base currency is sterling, right? And 8 o'clock, 158.50, 805. $158.70. So this base currency has increased in value. It's gone up from 158.50, it has gone up to 158.70. Now, for you to make money, to have made profit, you should have bought sterling at 8 o'clock and sold sterling at 805. Right? If you had bought 1 million sterling, you have bought 1 million sterling at 8 o'clock, say 158.50 dollars, you would have sold 1 million. Then at 805, we sell 1 million sterling. Dollars, you will receive 1.587. This is 0.002 million. $2,000 profit. You will make a $2,000 profit if you have done this. It's 8 o'clock. You buy 1 million sterling, 158.50. You spend $1.5850 million. Then 805 you sell 1 million sterling, 15870, you receive 1.5870 million dollars. Right? Profit $2,000. Next area is on average cost calculation. Right? So you're buying 5 million sterling, 155.10, then you buy another 10 million, 155.60, and you buy 5 million, 155.40. What is the average cost? Right. So let's see. Buying 5 million. So let's put 5 million plus. $155.10. You buy 5 million, $155.10. You're spending 9.755. Right. It's minus dollar outflow. Then you buy 10 million, 155.60. Sorry, it's not 9. Then you buy another 5 million. $155.40. So in total, you have bought 20 million pounds and sold $26.081 million. The average cost. I have made a grade 2 mistake by 5.560. $1.5542. Right, so any questions up to now? All right. Next example. Average cost of profit or loss calculation. First one is you're buying 5 million of 93.40. You buy 10 million of dollars 93.25. You buy for 5 million 93.55, and finally sell 10 million of dollars 93.10. Closing Aussie dollar US is 93.89. So what is your profit or loss? Right. So these are the set of transactions. You have bought 5 million at 93.40. Then you buy 10 million of dollars 93.25. Buy 5 million at 93.55. And finally sell 10 million 93.10. So let's calculate the dollar amounts. Aussie dollar inflow means US dollar outflow. Finally, when you buy Aussie dollars, you are selling US dollars, but when you sell Aussie dollars, you will be buying US dollars. So this will be plus 3.0 million plus. These are the transactions that you have done. And the question is to find the profit or the loss. How would you do that? Now compare this with the mango example. Both are identical. And you have been given the closing price of a mango as well. 93.89. What do you think should happen? Will you make a profit or a loss? The first step is to total these up. So 5 plus 10 is 15 plus 5, 20. Minus 10 plus you end up with a positive of 10 million. 10 million, you are left with 10 million Aussie dollars. Because you have bought 20, you have sold 10, you are left with 10 plus. This is overbought. Aussie dollars overbought. In US, okay, why do you say profit giant? So you get a loss of 10,000. Is it? Oh, sorry, $1,000 loss. Average cost is 0.39. Can't be, because all the costs are 0.9. So you can't get 0.3. Not possible. 0.939. Let's say average cost is 0.9390 and the closing price given as 93.89. Yeah. Right. So let's see dollar terms you left it. $9.3625 million. And it is minus. So the average cost is what I get. Closing price is 93.89. So if you were to close out at the closing price, then you need to say 10 million at 93.89. And you would end up with 9.89 million. Put in 0. Which is $26,500 profit. That is your profit. Okay, so you may have made a mistake in your calculation. Do you get the same answer? Yeah, you have made a small mistake. Right. Okay. So this is the profit that you make. Okay. Right. I'm going back to long and short. What do you mean by long and what is short? Now this pen, take this pen for example, right? If I bought this pen, I am long a pen. That means I have bought this pen. So if I sell this pen, the same pen I am selling. I bought the pen under, and I am selling the same pen. Let's say 100 pen. So I make a profit of 20. Now I bought this pen and I'm selling the same pen. When I buy, I am long. I buy this pen, I am long a pen. Does it mean when I sell it, I am short? Selling this pen means the pen that I bought, if I sell it, does it mean I am short? Answer is no, it doesn't mean I am short. It means I am squared. Like I have bought a pen, I have sold the same pen, then I am squared. Right? So what is short? What do you mean by short? Short means I don't have a pen. Right? But I have sold a pen. Let's say I sold a pen. I don't have pens. I am selling a pen. Without having a pen, if I sell, then I am short. Why will I go short? Why will I go long? Yeah, when I buy a pen, I'm long. I will buy a pen because I expect the price to go up. If the price goes up, then I make profits. But if the price goes down, when I'm long, if the price goes down, then I will lose. If I sell this, for example, if I sell this for 80, then I will lose 20. Then why will I go short? Why will I sell a pen which I don't have? Because I expect the price to go down. Right? If I sell a pen at say 100, I get 100 bucks. And if I'm able to buy this pen back for 80, then we have squared, and I make profit of 20. But okay, so if I go short and the price comes down, I will make profits. But if I go short and the price goes up, if it goes to 180, then I will lose. Okay, so you go long, expecting the price to go up. Right. So the risk is price coming down. Then short, expecting the price to drop. So the risk, price going up. Right. I hope that was clear. Long and short. You need to understand the concept. Okay, so any questions on today? Okay, so if there are no questions, let's wrap up for today. Thank you very much. Have a safe week. I will see you all next week.